Here's the thing. Jeremy Grantham opens the interview with a chilling message. The current market is more vulnerable than any we've ever seen. This statement alone should be cause for alarm. In fact, what's even more distressing is that Grantham hints at a historical pattern where high market multiples predict disaster. What's even more distressing is, according to Grantham, the market is preparing to take a nosedive, despite clear warning signs. And this might be the perfect setup for what Grantham believes could turn out worse than the 2008 market crash. Now, artificial intelligence is the new thing that's caught everyone's attention. But could the soaring hype around AI be setting us up for a catastrophic market crash similar to the dot-com bubble? Now, Grantham draws a fascinating comparison here. You see, just like back then, today's market is riding high on hope. Except now, it's AI and tech driving the overvaluation. Think of it this way. In the 90s, everyone thought the internet would revolutionize the world overnight, so they bid up the stock prices of every tech company they could find. Turns out that revolution didn't happen fast enough, and the bubble burst. Now we're seeing the same thing with AI. But what I'm going to reveal next is perhaps the most interesting part. Grantham isn't suggesting AI is not transformative, it is. But the current market valuations for these tech companies are just way out of line with reality. And in case you're not aware, the dot-com crash wiped out nearly 75% of the NASDAQ. Sadly, today's market is even more overinflated, and when this tech bubble bursts, the crash could be so much worse. Now, Grantham is warning us that today's overinflated tech valuations are layered on top of an already unstable global economy. So when the fall happens, it won't just be tech stocks taking a hit. It could ripple across every sector, causing a widespread market collapse worse than what we saw in 2008. But could the recent uptick in unemployment be the strongest signal yet of an impending recession? And if history has shown that even a slight rise in joblessness has always led to an economic downturn, are we already too late to stop what's coming? Okay, so let me get this straight. Grantham's essentially saying that when unemployment rises by even a tiny amount, a recession almost always follows. And as most of you might already know, a 0.5 increase in unemployment leads to a recession 70% of the time. But what's even more distressing is that once it hits 0.06%, a recession is 100% guaranteed. Now, unemployment is already creeping up, which is a huge red flag. And the crazy part is, we're not just dealing with a simple uptick. The broader economy is facing so many other issues right now. High inflation, massive debt, global instability, and a recession could be just the tip of the iceberg. Even worse, the smallest rise in unemployment could set off a chain reaction that might plunge the nation into an economic tailspin. But what truly happens when government stimulus turns into a ticking time bomb for the economy? And how close to the blast are we? Let me explain. Grantham is clearly pointing out how, over the last decade, governments have poured trillions into the economy, creating an illusion of stability. The real problem here is that this has blown up asset prices to absurd levels. Think of it this way. Homes, stocks, even crypto. Everything has been artificially popped up by all this money being pumped in. On top of this, interest rates are rising, and once those cheap mortgages and loans run dry, we're going to see the real estate market crumble. What Grantham is simply saying is that the higher asset prices climb, the more brutal the eventual collapse will be. Let me make this clear. Grantham doesn't think that this is just a bubble in one sector. He believes the entire economy is overinflated. Turns out that much of this comes down to the government stimulus measures that kept things afloat after 2008, and especially during the COVID pandemic. And if you think that's disturbing, wait until you hear this part. When the bubble finally bursts, it won't just be real estate or stocks in trouble. The entire financial system could be facing a crisis far worse than 2008. Which begs the question, is the current market setting us up for an even more painful crash than we've seen before? And if Jeremy Grantham was right about Japan and the tech bubble, could we be facing something even more ruthless in the coming months? Here's the thing. Grantham has been ringing alarm bells for decades, and he's been right more often than not. But as a quick reminder, markets tend to ignore these warnings until it's too late. I think we can all agree that the market has a nasty habit of getting caught up in its own hype until the bubble bursts. And here's where it gets interesting. Grantham believes that each crash has become more brutal than the last because of one simple reason. Each bubble has gotten bigger. What's more, Grantham is warning that today's market is in a much more precarious position than ever before. The stimulus measures, the ultra-low rates, the speculation, it's all created a perfect storm. Now, the 2008 crash was bad, but Grantham says that the next one could be far worse because this time, the entire financial system has been propped up by artificial stimulus for over a decade. Meanwhile, investors have gotten complacent, thinking that the Fed will always come to the rescue. But what happens when the bubble bursts, and there's no easy way for governments or central banks to intervene? Well, as Grantham predicts, the crash will be even more ruthless. So if history is any guide, we're headed for a painful correction, perhaps the most brutal one yet. Which leads us to the question, could the massive rally we're seeing in the US stocks be the calm before the historic storm? And if this rally mirrors the explosive gains right before the past crashes, should we be bracing for an unprecedented financial collapse? Now, Grantham explains that despite the recent rally in US stocks since 2022, fueled mainly by the AI hype and mega cap stocks, the historical lens suggests something troubling is coming. You might be wondering, why does this matter? Well, as Grantham emphasizes, stock market rallies often happen right before significant crashes, not when the economy is stable. The truth is, rallies like this can be misleading, blinding investors from foreseeing disaster. But wait, there's more. Grantham touches on how historical high PE ratios, like those seen before in 1929 and 2008, predicted the worst economic downturns. This sets up a clear warning. These current market conditions, particularly driven by speculative bubbles, are signaling something far worse than we experienced in 2008. But are we ignoring the haunting parallels to 1929's lost decade of Japan? Okay, so let me get this straight. Grantham draws a haunting parallel between today's market and three of the most infamous crashes in history: 1929, Japan's lost decade, and the 2008 financial crisis. Each of these events followed a period where markets reached their highest peaks, only to crash spectacularly. As it turns out, the market tends to project heaven just before it demonstrates hell a lot of the time. And this is where things get chilling. To put things into perspective, Grantham isn't just talking about a typical downturn. He's suggesting that, like the Great Depression and the 2008 financial crisis, the next crash could bring not just economic pain, but fundamental breakdowns in global trade and currencies. It's worse than 2008, because unlike then, today's market is more speculative, more reliant on false optimism, and perhaps more vulnerable. But this next part is the most interesting. Now here's the crazy part. Grantham underscores how today's market, by the most predictive measures, is even more overvalued than it was during the peaks of 1929, 2000, and 2008. What's more, these super bubbles tend to burst in the worst possible ways, unleashing economic havoc. And if you think that's troubling, wait until you hear this next part. He's adamant that history has shown that the market won't warn us. It will feel like the best of times right before it crashes. According to Grantham, the current market is walking right into disaster, just as it did before previous crashes, only this time it's more fragile and unprepared. Which begs the question, could the Fed's next interest rate cut trigger the market crash everyone is rooting against? Here's the thing, when the Fed cuts rates, people are almost always excited, right? Yet, what many fail to understand is that these cuts don't come because the economy is thriving. In fact, Grantham points out that the worst market crashes typically follow right after the first interest rate cut. We've seen this happen time and time again. Investors get all hyped up, thinking the Fed is swooping in to save the day. But then, boom, the market tanks. And in case you needed more proof of this, think of what happened in 2008. The Fed cut rates, and the market crashed even harder afterward. Which begs the question, are we setting ourselves up for another catastrophic failure? I think we can all agree that Jeremy Grantham's warnings are a stark reminder that what's coming could be far worse than the 2008 crash, and we have to stay on the lookout. Now we've handpicked some videos that we'll think you'll find incredibly beneficial as well. They're right here on your screen, so be sure to check them out. Don't forget to like this video and hit the subscribe button, and we'll see you in the next one.